Good afternoon and welcome to our second tutoring session for the online Principles of Accounting 1 course. I'm Victoria and I'm glad to be with you here again today. In this first session we are going to go over an adjusting entry problem. Okay, so this is from chapter 4 and this is a problem that's probably going to be on your test this coming Monday. The problem that we're going to do is exercise 411. Okay, so this is on page 207 in your text. And just big picture, we're going to talk about what's going on, okay? So adjusting entries, okay? Let's imagine you're a baker, okay? And you own a bakery and you work at the bakery, and at the beginning of the month, you go out and buy $100 worth of flour and sugar, okay? And let's say in the middle of the month it's my birthday and I want a birthday cake. So you're going to use half of your flour and half of your sugar to make me a birthday cake. And then a couple weeks will roll by and you go look in your pantry at the end of the month and you realize you only have $50 worth of flour and sugar left in your pantry, okay? When you use supplies like a baker does with flour and sugar, you incur and accrue a supplies expense, okay? So what does this mean for accountants? Okay, so when you accrue an expense, you have to show on your books in a journal entry that what you originally said you bought supplies for doesn't represent what you actually own anymore, okay? So like I said, we're going to do exercise 411 on page 207. And you'll notice in the problem that it says you're going to be referring back and forth to page 168. I believe that has an adjusted trial balance that you'll be using to figure out some of your values for some of your journal entries, and it is a trial balance. So let's just get started. So the first problem, it says supplies on hand at October 31st total $500. Okay, so just in the little example I just said, you go and look in your pantry and you have $500 worth of flour and sugar. Okay, just for that example. If you look on page 168, you notice that on October 31st, you had $2,500 of supplies. So you know that you have used $2,000 worth of supplies, okay? So what you have done is you have incurred a supplies expense, okay? So for an example like this, you would have supplies expense as your debit, and you would credit supplies, okay? Because you're incurring a supplies expense, which is increasing, and because you're using the supplies are decreasing, okay? So adjusting entries are kind of dealing like that with asset accounts, okay? So that would be part 1 for $2,000, okay? For the second part of the problem, it says expired insurance for the month is $100, okay? So this is the same example, kind of what part 1 was for, except it's with a different asset account, okay? So if you bought $1,200 worth of insurance for the year, okay? In January, that means you have $1,200 worth of insurance. But once you hit February, you only have $1,100 worth of insurance because every month it expires. So when you hit December, you still don't have $1,200 worth of insurance. You have $100 worth of insurance, okay? So for the second problem, you would again debit insurance expense because you're incurring the expense, and then you would therefore credit the prepaid insurance because the insurance is actually going away, okay? So moving on to the third one, number 3 says depreciation for the month is $75. Okay, so depreciation is kind of a different concept. Let's imagine you're still a baker, okay, and when you use flour and sugar, okay, it actually goes away, okay? But let's imagine that you went out and bought a brand new mixer, okay? When you use the mixer, part of the mixer just doesn't go away when you use it, okay? So a way that accountants allocate costs, remember that, allocate cost, is through depreciation. So what happens is instead of allowing the company to take a hit in the stomach for a $10,000 mixer, they will depreciate the mixer every so often so that the cost is allocated, okay? So that's what's going on in part 3 of this problem. So it says depreciation for the month is $75, okay? So instead of actually decreasing the asset, which is the mixer, instead of actually decreasing the equipment, which isn't happening, the equipment's still there and is still working, instead of doing that, you will use something called accumulated depreciation, okay? So for part 3, you incur a depreciation expense as your debit, and then you will credit accumulated depreciation, okay? And that amount would be the $75, okay? So already we've talked about how to put an incurred expense on an asset. Now we've done that with depreciation. So carrying on, for number 4, it says as of October 31st, services worth $800 related to the previously recorded unearned service revenue has been performed. So unearned service revenue, if you look in the front part of your book, the very first page, it is a liability, okay? Revenue can be recorded once it is earned, okay? So if I'm going to pay you to come trim trees at my house, okay, and I pay you $100 in advance, you haven't earned the revenue yet because you haven't come to my house and trimmed the trees, okay? So what it's saying is they have performed what was originally unearned service revenue, okay? So when you actually perform the service that people have paid for, because unearned service revenue is when someone prepays you for a service, okay? Because you have a liability to carry out what they've paid you to do, and you actually perform it, you can cancel out what you had for that service, okay? So you can take out the balance of unearned service revenue and credit service revenue because you've earned the revenue, okay? So for that one, and again, this is number 4, it says services worth $800 for unearned service revenue has been performed. So you can debit unearned service revenue and you can credit service revenue because you have earned the revenue because you've done the business. You've completed the obligation that you made for the customer paying you, okay? So for number 5, it says services performed but unbilled and no receivable has been recorded at October 31st is $280, okay? So what that is saying is that you have not billed $280 worth of your customers for what they've done, okay? So accounts receivable is an asset account, okay? And what it is when you go perform a service for a person, okay, they will pay you later, okay? So those are people that you can fill out a bill and mail it to them and they're going to pay you back, okay? That's an accounts receivable, okay? So what they're saying is you just need to account that they're going to pay you, okay? So what that is, and you might have had one of these before, I'm not quite sure. So you need to record the accounts receivable. So if they're going to pay you, that's increasing an asset, so you'll debit it, and that will be accounts receivable. Okay? And then because you've earned the service revenue from doing the job, you can credit service revenue. Okay? Easy enough? Okay? 6 and 7 are really similar. We'll probably do both of those, so let's just get on with it. But they both kind of deal with incurring expenses, okay? So for number 6, it says interest expense accrued at October 31st is $70, okay? So when you have an expense and you haven't paid it yet, you're dealing with an expense account and you're dealing with a payable account, okay? So when you incur an expense, you also incur a payable, because if you incur the expense, you eventually have to pay it. So you also, therefore, incur a payable. And so for both of these, they're kind of the same thing. So 6 says interest expense accrued at October 31st is $70, okay? And 7 says accrued salaries at October 31st are $1,400, okay? So if you were going to do this for either one of these, you have your interest or salaries and wages payable for part 7. You've got your interest expense And then you've got your interest or salaries and wages payable for your debit and credit the corresponding amounts. Because what it's saying is you've incurred an expense and you owe them later. Okay? So what we just talked about were adjusting entries. Okay? That's going back and instead of just having the balances in your ledger, your T account, you're going through and adjusting those to actually show what is in your company at this particular time. Okay? So I hope this was helpful. And in our next video, we're going to talk about closing entries, what deals with revenue expense account and another account called income summary. And then we'll eventually tie all that together with retained earnings. So I hope this was helpful, and I'll see you next time.